In this video, we're going to talk about things that you need to understand between the different business entity structures. And when we talk about business entity structures, we're specifically talking about S corporations, partnerships, and C corporations. There's three big things that you need to understand that work differently between those different business structures. And this is not all inclusive at all, but these are three things that I think you really should need to know when you're working with these business entity clients. The first one is profit allocation. Profit allocation is going to vary based on the type of business entity structure that you have. For example, if your client has an S corporation, typically they have to allocate their profits and their losses based on their ownership percentage. So if you have 3 owners and they're all equal owners, then profits and losses have to be allocated 1/3 to one owner, 1/3 to the other owner, 1/3 to the last owner. There's really no way for them to change that profit allocation unless we start getting into compensation rules and paying them as a salary. But when it comes straight to how we're allocating profits, it has to be based on ownership. For a partnership, you have a little bit more leeway. Partnerships can structure their profit allocation in a way that makes the most sense for them. So you might have 4 partners that are equal partners for equity. So partner A has 25%, partner B has 25%, so forth and so on until you get to 100% equity. But you can structure the profit allocation within the partnership agreement so that partner A, who maybe brings in 90% of the revenue, gets 90% of the profits and none of the losses in the first couple of years. That flexibility is unique to partnerships. It's not available in S corporations. In C corporations, typically profits are going to be allocated based on their share of the business, unless they have a different class of stock. And you have common stock, you have preferred stock, and preferred stock gets preferential treatment. So the second thing that you have to understand that's different between the different business entities is how owners are paid. In S corporations, owners can get paid through distributions, and they also can get paid through reasonable compensation. If an S corporation owner is actually working in the business, they're no longer just an owner, they're also an employee. And if they're being paid for their services, they have to be paid as wages before you are able to allocate any of the money that they receive to be distributions. So this is what we call reasonable compensation. The IRS know that people have those tricks, so they require S corporations to pay their employee owners a salary. So now they're also paying into Social Security and Medicare on top of just the regular income tax. That's different than a partnership. They cannot be considered employees of their business because they're technically not separate from their business in the way that employees in a corporation are. So if you are a partner, your client is a partner in a partnership, and they're being paid specifically for their services, they get what's called a guaranteed payment. It doesn't show up on a W-2, it shows up on the Schedule K-1 that they receive. Owners in a C corporation get paid through distributions that we call dividends. And if they are also employees in the business, then they would also be required to be paid as employees, so they would get paychecks and get a W-2 at the end of the day. And last thing that you really need to know is basis. Basis is similar between the 3 different business structures, but it is also different. Basis is pretty much just the owner's investment in the business. And it starts out with how much money they contributed to the business, and it increases and decreases with certain things. Profits in the business will increase it, losses in the business will decrease it. But partnerships specifically also have their basis impacted by any debt that the partnership brings in. So if the partnership itself goes out and takes out a loan to buy some equipment or anything like that, that actually impacts the partner's basis. The only time debt in a S corporation impacts shareholder basis is if the shareholder themselves loans money to the business. You can have 2 businesses, one being an S-Corp, one being a partnership, that have very similar situations going on, and the partners in a partnership could have very different bases than the shareholders in an S corporation because different things impact basis. With C corporations, they also have basis. It's not as complicated to track. It really is how much did you pay for the shares. There's very little that really impacts C corporation basis in the same way that S-Corp and partnership basis is calculated. That's all I have for you today. If you really like this video and you want to see more like it, make sure you subscribe to this channel, turn on your notifications so that you get notified anytime I post a new video. And until the next time, I will see you later. Bye.